Hi everyone, and welcome back to Locked In, the platform where we at Cuboid get to talk about stuff. The purpose of this video series is to explore various topics that will help educate, inform, bring awareness, and hopefully create that light bulb moment for our viewers to consider self-storage as a great investment choice. As a recap, in the first episode, we explored perceptions around self-storage facilities and the diversity of buildings that can potentially be converted into a self-store. This was also supported by some of the drivers of continued demand within this marketplace. In last month's episode, we were joined by three of our customers, who included a farmer, a family-owned real estate investor, and an ex-electrical contractor, who have all made that leap into the self-storage world. We explored how they entered the self-storage market, their learnings, their findings, and the experiences to date. In today's episode, I am joined by Simon Forrester, my co-host, who is the CEO of the Self-Storage Association. I'm also joined by Caleb Mercer, the Managing Director of the European real estate arm of Heitman. We're going to be addressing whether self-storage continues to stand out as a compelling investment opportunity. Now, before I let Caleb make his own introductions, for those of you that don't know, Heitman was founded in 1966 and are a global real estate investment management firm with around $47 billion in assets under management. Heitman has significant expertise in the self-storage sector, as well as numerous investments across the globe, including the U-Storage portfolio in Ireland, which we believe, as of today, is the largest purpose-built, tech-enabled facility in Europe, and closer to home, the Space Station brand, which has around 20 facilities darted around the UK. Okay, so as mentioned, we have Caleb Mercer with us today. I'm going to hand over to Caleb to introduce himself and talk a little bit about his role at Heitman and why he's here talking today about investments within the sector.
Great, thank you. So I've been doing real estate investment in Europe for about 20 years now, and I've worked across lots of different asset classes. So I've done things like hotels, which I really enjoyed with their rich value creation. But I've also done offices that were very dry by comparisons. And one of the reasons I came to Heitman was so we could work in sectors like self-storage that have that really rich operational side to them, which I think allows investors to achieve better outcomes than investing in, say, a traditional office building. So very glad that we get to work with Cuboid on our self-storage investments, and it's a really great sector to be in. My role is to run the investment part of Heitman's business in Europe, and some of our funds that we invest into self-storage, amongst other things.
Great, that's really great to hear, and thanks for that, Caleb. So let's just kickstart this conversation really by finding out from you, Caleb. You know, you've mentioned you're in different markets before, you've worked in different sectors from the investment perspective. Now you're exposed a little bit more to the self-storage world. Let's talk a little bit about that. What have you found from this sector?
I mean, it's a really great sector. Obviously, we've been investing in it for a long time as a business. We used to own a controlling stake in Shurgard, which obviously is Europe's largest self-storage business. And since then, we've gone on, as you were saying, to invest in Ireland, the UK, Germany, and Sweden currently in terms of our self-storage portfolio. And we've been doing it globally for even longer. We've been investing in self-storage in the US since the 90s. So it's a sector that we know really very, very well. And we find it's a really great institutional investment product. It delivers better outcomes in times of recessions. It's a sort of product people always need. That's not true in some of the other asset classes like offices. When you're in business and you're thinking of profitability, you're not necessarily going to upgrade and expand your space in the middle of a downturn. But the nice thing about self-storage is those life events that happen, they keep happening no matter what. So we find it tends to be a much more reliable sector for us in times of trouble. So we enjoy that side of it. We enjoy the opportunity to create value in the buildings, either by extending them, upgrading them on the physical side. Sometimes operationally, we're able to bring in some of the systems that come with being a larger owner of self-storage and apply them to the businesses to create some value operationally. I really love buying up different assets and developing new assets to create portfolios of scale that we look to then sell on to sort of lower risk, lower return investors that want that access and exposure as they increasingly do. So it's a great sector in the way you can create that value in the physical operational and the portfolio side. It's also very well priced. It tends to have a better yield than the other sectors, especially after you factor in capex leakage. As much as there is capex to be done, as we know, it's not as much as, say, an office building where you're having to refit it and upgrade it fairly regularly. At least in self-storage, once you've up and built it, there is some capex investment, but it's less so. So not only do you start with a high yield, the amount you're having to reinvest to maintain that yield is better. So that income over a long period pays off. It delivers a better return, we feel, than some of the other sectors. So we love it from that point of view as well.
Very good, very good. I'll hand over to Simon, who's probably got a few questions for you. I want to delve into that a little bit.
And thanks for promoting me to co-host. I would like that in the introduction. Thank you very much.
No problem. Well, you've been through your interview process now on the first two podcasts, and you did all right. You're getting better. So
thanks for the feedback.
You're now promoted.
Excellent, great news. So, looking back from where you started, Caleb, how do you think the market's changed and evolved over the years? What are the main differences from where you began to where we are now?
Yeah, I mean, I would say if you look right back to when Heitman started in the 90s, it was doing buying off a lot of private individuals and working much more on putting assets together of all sorts of scale and quality and size, and operationally the techniques were less evolved in those days. I think the market's come on a lot. You now have these very big, large players that we work with in the US, we joint venture with, and it's much more institutionalized as a product. And I think in Europe the same trend's been going on. If we look back to not even that long ago, 5, 6, 7, 8 years ago. You just didn't have the ability to put in one go meaningful sums of money into the private markets. You could do it in the listed markets, but not into the private markets. And a lot more of the stock was perhaps in, say, UK and maybe Sweden and some of the other markets. But as time's gone on, you've seen bigger and bigger portfolios coming through. There have been a few larger portfolio sales in the last few years, and maybe more to come. And so you can now, as an institutional investor, you're starting to be able to access it in a more meaningful way in a single shot rather than having to build it up. And so that trend has been playing out, the same trend in the US. Operationally, we've seen all the evolution that you'd expect as technology keeps evolving. You know, AI is the latest thing everyone's talking about, and we're using it in our businesses, as many people are. The way we set rents has evolved a lot. We've always had pricing systems of various sorts, but they're getting more and more sophisticated as the technology allows you to draw in data and analyze it and work with it better. So the operational side's come on leaps and bounds as well. So yeah, I think we've been following the same trends as the US, but it's just this continual evolution, this continual need to stay up to date and be a best-in-class operator and to build these portfolios and access these portfolios.
Sure. I think just to dig into that a little bit further, I mean, we know where the market sits today, and we all analyse the market as closely and as live as possible, and we know it's a growing market. We know it's going to continue to grow. Currently valued at sort of £1 billion within the UK, and estimated to grow at a lot, sort of 6 to 6.5% by 2033. Do you concur that you see the continued growth that we have seen in previous years? If for the next decade ahead, is everything looking likely that the industry within this market is going to continue to keep growing?
I don't see why it wouldn't. If you look at the amount of stock per capita we have over here in Europe as a whole, it's sort of, I think, around roughly 1/20th of the stock that the US has, depending on how you measure it.
Yeah.
So we don't have to catch up with the US, but that gives us plenty of room to grow. And even within Europe, if you look at the different geographies, obviously there are markets like the UK and Sweden, some of the others that have higher levels of stock per capita, but you go into Germany and some of the other markets, and even if they just capped up to the UK and Sweden, that's an awful lot of growth that can happen. And obviously awareness has been a big challenge when we go into some of these markets. We notice that in markets with greater awareness, then you have better lease up rates and you fill quicker, and so it has the capacity to absorb more stock more readily. So that has been the biggest holdback, and that builds over time. We have anecdotes of people, even in the UK, which is a more mature market, people living opposite our stalls, walking in and asking, what is it that you do in these stores? And so even in the most mature markets, there's scope for further awareness.
I think here at Cuboid, I'm sure Simon's finding the feet as well. There is an element of education we all have to go on with our client base as well, and prospective client base. That, you know, we did an investor day some years back now, and we brought a bunch of private investors along just to try and educate them on the market, drive some awareness. And it was astounding that, you know, these were very successful investors and they didn't know about the self-storage market, the growth, the margins, where it sits, you know, the barrier to entry and everything else. And it was something that caught me by surprise. You know, these people with their fingers on the pulse, constantly looking at new ways to keep growing revenue, and they really did not know about the self-storage market. I found it, you know, eye-opening, really. It was a little bit, well, we've got a bit of an educational platform to put together. That's why, you know, these things like the podcasts are now with us. But I think we all assume that we are a maturer market, but don't necessarily expect everyone to still know about it yet, how it works and what to do. So we definitely see the same things from the other side of the coin, for sure.
And I think from the association's perspective, we've got a role either at the UK or at a European level to get that message out to the public to say that self-storage exists, and it can, as you were saying, those life points where self-storage crosses, we need to emphasise that really strongly to people to grow that pie. Awareness is at about, use is about 4% in the UK versus 12% in the States. There's a lot of more we could go at there. So we've all got a role to play to raise that awareness.
No, I agree. It's interesting when we speak to our US colleagues, they'll talk much more about lifestyle customers who are using it, which you see a little bit of in Europe, but nowhere near to the same extent. So I agree. There's a lot of evolution. Obviously, doing a great job in trying to bring that awareness into the market. But yeah, there's a long way that we can go.
Absolutely. I think to kind of draw it back and help some of our potential viewers who are going to be watching these podcast series, some of the things that we often find at Cuboid we get asked a lot about, definitely with new people coming into the sector, is with the high level M&A activity we're now seeing within the sector, and the difficulty in finding prime locations and sites becoming a bit more of a challenge than it was 5 to 10 years ago. Now, one of the questions we get asked a lot is, are we anywhere near a saturation point? And because of the high level M&A activity within the sector, is this going to be really difficult for me to now penetrate this market? And it's something I've been in the industry a long time and never used to get asked this question. It's becoming quite a frequent question from serious people coming into the sector. Can you shed some light on that, some data, maybe some comfort around that point?
About whether institutional investors can get into the sector and find their right access points.
Exactly that, yeah.
Yeah, I mean, if you look in the US, it's sort of 1.5 times, I think, more consolidated than it is in Europe. And there are still plenty of opportunities to come into the sector. So I think it should be possible. I think it'll be interesting to see as these operators and REITs become bigger, whether they start doing more third-party management. I know there are various entities trying to do that. That's the trend that came through in the US. And so I think that will provide one point of access. You won't necessarily need to be the owner of all the real estate and the operator. You'll be able to split the two up, and that will create more
like a franchise model, isn't it? Is that correct?
Like a franchise hotel third-party management type contract, maybe model. So you'll see more of that coming through, perhaps, and that will create more access points. I think it is a feature of the sector that if you're wanting to invest into the sector, you do from time to time see portfolios of scale that you can access, but they're still relatively rare if I compare it to the other sectors that we can invest into. And so you either have to take one of those rare opportunities and normally pay the price that is commanded because of that scarcity, and perhaps the premium isn't quite the same right now as it would be in other times, but you either make the decision to do that and your cost of capital has to reflect that. I still think you earn very good returns by doing that, and so it's a very rational choice to make, but that's one route. Or you have to be willing to go one by one, and that is a different style of investing, and often it's not always buying standing assets because there aren't so many square meters to buy, and so you have to be willing to take development risk of some sort, and that's a different type of investor at the end of the day. So even now it may not suit all investors in all ways, but if we look to the US, the market evolves and there will be access points to it, and any rational business will look at the best way of growing and expanding itself, and they'll create opportunities for people with the right cost of capital to access the market.
Sure. Okay. Hopefully that gives people some comfort for sure.
And I think just picking up on that point about comparing the UK to the US, I mean, obviously the rest of Europe is perhaps further along that, not quite as far along that journey as the UK, but lots of people have said to me, "Oh, we're X years behind the States."
Yeah.
X is a movable feast, like
Yeah.
multipliers. It could be anything from 1 to 1 million. But in terms of that, where we are mapping back to that. That growth is still mapping across to what they saw in the States 10, 20 years ago. So if we continue along that journey, then we'll be seeing that market penetration rate probably along the same lines as roughly the States. Obviously, land is more at a premium, and what was Wilde's quote? 2 people divided by a common language. We're not the same as the States, but we are definitely moving in the same direction. So I would see, certainly, I think in our lifetimes, at least the market will double in terms of its size and scale within the UK. So there's, as you said, a lot more to go at.
Yeah, I think we're seeing the same things, a level of activity that we see as well, even from, it might not be a traditional institutional investor, but other business owners, entrepreneurs that have done well over their time are absolutely looking at diversifying that portfolio or adding to it. And I think that's really encouraging to see as well, that there's still that sort of Joe Public customer that's coming in and wants to grow a successful business from self-storage. And I think some of the drivers from that are that, we went through the COVID times, and that's driven a lot of businesses to a point of where it's just non-viable anymore to run that business. But then they're now sitting on assets. They've got facilities and buildings that they own that can now not do anything. And some of those people in the agricultural market really applies to this. And we're still seeing that influx of customer base coming through to reclassify their business and their portfolio to get into the storage market. So
and we're seeing it with warehousing, like industrial removal companies as well, where the downturn in people moving house means they've got a huge facility with capacity there and a car park that isn't full of vans anymore. So they've got internal and external storage opportunity there, and a team of people that could adapt relatively easily. So we've seen quite a few removals companies come to us and talk to us about this as an opportunity to get into.
I think it's one of the great things about the sector is that it can be so flexible with the real estate that it repurposes. If you look at some of the other sectors like residential, you get office buildings that you'd love to turn into residential because they're in the middle of a city, but the floor plates are so deep that you can't get the natural daylight in, and obviously people would like to have daylight if they're living in a building, but the nice thing about self-storage is it doesn't have the same constraints. It can handle all sorts of different physical real estate and still work as long as it has the right catchment around it. So I think I can see there will be many chances like that, and it evolves through time. It used to be more retail, and that's probably a little bit less now, and maybe a bit more office, we'll see. So, or car parks, who knows?
Well, yes, as we were just talking off camera about the news of NCP. So there's, again, potential market there to change that into self-storage. So, as we were saying in the first edition of Locked In, that there are so many spaces that can be converted.
Absolutely.
So if you own something, really look at it now and see could it be converted? Talk to people about it.
Yeah, absolutely. And I think even when you educate someone, even if they're running an existing business, so I'll give the example. I spoke to an agricultural business, and they're currently storing grain in sort of an 8,000 square foot warehouse, and the price per square foot that they're getting for the grain is unbelievably cheap. And when you educate them, say, well, with a little bit of investment, you can quadruple that number, if not more, by running a self-store. So again, it goes back to the educational platforms to educate people, the right people in the market, that this self-storage is a good thing to be looking at, and often is going to yield a much higher return for you from what you're currently doing within that marketplace.
Average of £26 a square foot from last year's survey.
Yeah,
that's way better than we were talking about commercial before. That's a significant increase per square foot.
Absolutely.
So done right, using the right supply chain, you can make a lot of money at self-storage.
And I think the barrier for these types of people as well is less now with the tech solutions that have come into the industry. We often hear a lot of people talk and say, I'm open to doing it, but I don't really want to run it. I don't want to be a part of it. I just want to put the money in and walk away. And that was always very historically difficult. but not anymore, not in today's world. You know, the tech advancements that are coming into the sites, the tech stack that these businesses can use now is allowing platforms to run completely remote, staffless, you know, and as autonomous as possible. So I think it's even more an appealing investment for institutional investors, but also, you know, Joe Public who have done well over their time.
Yeah, going back to the last issue of Locked In, one of the guests was saying that he was running his self-storage business from literally from a lie low in a pool at one point, and our customers calling him saying, "Oh, I can't get into a unit," and he was dealing with it literally off his phone while he was drinking a cocktail. I mean, that's pretty good work-life balance. I'd like some of that.
Yeah, I would absolutely like some of that for sure. I really would. But now, just sort of jumping back into topic a bit, Simon. I know there's there's compelling evidence that the industry is continuing to grow. The investment continues to keep coming into this space. The opportunities, you know, are still arising. But something that I wanted to sort of touch upon again from the previous episode was, you know, I think you used the analogy of the gold rush, and it's to do things right and not the wrong way. And I think that's more apparent and more important now with where the market is and moving forward than ever before. So can you just recap on that point a little bit about starting these businesses off in the right way for self-storage as opposed to potentially causing yourself some hurdles downstream?
I think that whether you're an institutional investor or you're somebody that's looking to start up a business, it's all about the planning and the due diligence. It's about having a structured approach to this. And look, I know I would say it, but start with the association. Come and talk to us, because that's what we're here for. We're here to make sure that people are doing things right from day one. So if you've got a concept or a piece of land and you look or a farm building, start to look at how do you do this properly. And what I would say is talk to the supply chain. Come and talk to organisations like Cuboid, but you know, talk to there's planning experts. There's all sorts of people out there that can support you. But also talk to operators. It's a really friendly industry, and as we've seen with the approaches to people about this podcast, everyone's like, "Yeah, I'll come and talk about it." You know, it's not a sector where people are kind of hiding their cards. They're willing to go, "Well, these are the mistakes I've made. Learn from it." And that's one of the things I really like about this sector, that people are willing to share that information and are willing to do that. So do your due diligence and learn from your peers or potential peers in the marketplace.
Yeah, no, I think it's a very, very valid point. But I concur. It's probably the friendliest industry I've ever worked in. And a real community. Whether or not it will always be that way, I'm sure that will change at some point. But you know, you're absolutely right. The assets are out there. You know, the people are out there. The network's out there to go and talk to and draw upon this value that other people hold. And you can find online now. People will talk about their own numbers. You know, we'll talk about how they've scaled their numbers and what they did wrong, and now they've fixed it. What does it mean for their numbers? And there's not many industries that you can go and readily find that out in the marketplace, you know, for your own benefit. So yeah, I absolutely agree.
So it would be remiss of me not to mention our conference as well, just as I've got to get the sales plug in there, which is Telford at the end of April. So if you're a potential investor or you're looking to open your first business, come along. We've got 24 specific sessions across the 2 days just for people who are looking to move into the sector. So covering everything from insurance, planning, land use, you know, right through to every aspect of the process of getting to the point where you're cutting the ribbon on your first self-storage location. So,
and obviously they get to speak to, you know, the fantastic team at Cuboid.
I was going to say that you guys, and yeah, you guys have been fantastic supporters of the event, and as principal sponsors, you know, it'd be great for people to come along and see you. So yes, if you're going to come to the event, definitely come and see the team from Cuboid, just to get an autograph. Absolutely,
yeah. It costs you nowadays though. But so if anyone did want to attend, anyone watching this wants to then come to this event, how do they go about getting the tickets, and where is it located? And
go on the SSA UK website, sssauk.com, and there's a button on there about the conference. You can buy a ticket, and if they talk to Cuboid nicely, they can get a little discount on their attendance as well.
Fantastic.
So get 20% off. But yeah, I'd certainly urge people to have a look at that. It's a fantastic opportunity to meet all of the sector under one roof across the 2 days. And I think you'll leave there, you'll have saved yourself some money and avoided some of those mistakes. So going back to the original point of this, I'll move off the sales pitch, which is about that analogy about the gold rush. San Francisco, 1800s, everybody rushed over there and they weren't prepared. They didn't have the right kit. Prepare yourself, because saving yourself that time and effort will mean you get to capacity, you get to profit, you get to stepping back from the business and get onto that Lilo with the cocktail a lot quicker.
And also any potential exit, it becomes a little bit more viable if that's within an operator's plans.
Absolutely, yeah. So Caleb, what's your advice to potential investors about how to successfully navigate and enter this market? And ultimately, do you believe self-storage continues to stand out as a compelling investment opportunity?
Yeah, I mean, to take the latter half of the question first, absolutely is probably our favourite pick in Europe still nowadays, and we're putting a lot of money into it. It has a better yield, more reliable yield, and ultimately in the long run, that's what you invest in real estate for, to get an income stream back, and it really has a better long-term income stream. It also, we look at what it does to a portfolio, so we look at diversification. When you run the analysis over the long term, self-storage, because it's driven by needs rather than the economy, it helps diversify away from your other exposures like offices or retails, which are more tied to the economy. So it's not only does it have a better income yield, but it helps de-risk your portfolio, and that's ultimately what investing is all about. So we think it's a really good sector. You can also add value if you know what you're doing and can do some of the physical and operational work and some of the portfolio creation work. So if you want to create value in it as well, it's also a great sector. So really definitely should be part of every investor's portfolio. What would I say to them? I think we've seen people come into the sector. I mean, we've been lucky to have been doing it for a long time. So we've built up our own data sets that we work with, and so we can analyze where you can take properties to, what's going to work, which ones will work well, which ones won't perhaps work so well. We understand the operational side and if you're going to run a man store, what sort of scale do you need and how many lifts do you need in the building and things like that, which are all very sort of boring things, but important things at the end of the day. So it's the trickiness is coming into the sector fresh, and particularly if you access one of the larger investments, but you have to pay for it, but then there'll be a team probably that comes with it that have that knowledge that you're lacking. But even then you may not have all the data, but at least you've got an operational team. But if you're going to come in and unless you're going to wait for one of those bigger portfolios and pay for them, then you've got to try and buy individual assets or small portfolios, and that probably doesn't come with the team data and history that you'd look like. So then I think the question is, how are you going to do it safely? We've seen people do it, not as great a sector as it is. Not everyone always gets it right. We've seen some missteps as well. And so if you're going to come into it like that, you probably need to find someone to work with who has that and has developed that for themselves and can help you on that journey as you try and build up your exposure within the sector. And I think that's perhaps for some investors going to be the hardest thing to work out. And so they need to find the right party. And there are people out there. And there aren't endless parties out there with that history and background in the sector, but they're out there. And you probably just need to work with one of those if you're coming into the sector at the end of the day.
Yeah, I think that analysing the risk with the portfolio and people trying to diversify that risk away to a bit of a safer investment, I think is a really key point. I think it's a really key point in the climate we sit in. Everything seems to change hour by hour at the moment, whether it's with economy, global conflicts, whatever it may be. So I think for potential investors that are watching this platform, I think it's to give you a level of comfort that your assets might be sat somewhere that is of an elevated risk for these reasons, and moving that risk into self-storage reduces. I think it's a really key point. Yep. I think it's a really key point.
We saw that in the pandemic that self-storage businesses absolutely thrived. I mean, it was right place, right time, and my predecessor in the SSA really worked to ensure that self-storage businesses remained open, and it was a period of really rapid expansion. We were undercapitalized, and the market had to adjust to expand to fill that gap. Yeah. And it really did move things on almost by a full percentage point. So there was significant growth there. That's not going to happen again, we hope, again, touch wood, but that steady growth is there. Coming back to the point we were talking about, the asset classes like offices, residential, I think that self-storage is one of the best kept secrets, that actually a lot of people just miss it and skim past it, when in fact the returns are significant.
No, I totally agree. If you look at the fundamentals of the sector, the long-term income growth ties more to labour costs than it does to replacement cost, and that means it outperforms over the long term on an income growth side of things. The yields, as I was saying, were already higher, and the capex reinvestment to maintain that yield is lower. It's the perfect product for, say, a pension fund to hold long term, to get that long term income growth profile that they want, and without having to worry. In offices, you're always buying office buildings, looking at the lease length, and over time that inevitably gets shorter, and you're desperately working to try and increase it out again. You don't have to worry about anything like that in self-storage. You have many, many thousands of tenants coming and going all the time, and so you don't really mind whether someone's leaving or coming. You're more worrying about, is it the right facility? Am I running it in the right way? Do I need to invest in it? Can I expand it out? And so it's a much more consistent sector as a whole. So it's a perfect product for a pension plan ultimately. And if you look at, in the US, we run a core fund that's part of what they call the Odyssey Index. It's sort of the main benchmark that the US investors use to look at real estate returns. And so it's very institutional, very core, lots of pension fund money investment in there. We've been successful by having a 20% allocation, I think, roughly to self-storage, which is a very significant allocation in real estate terms, but it's really helped deliver performance because of all those dynamics. It's an overlooked sector, as you rightly say, less overlooked in the US, I suspect, than it is in Europe, but nonetheless, it shows by allocating to sectors like self-storage that you can really drive out performance. So it's one of our favourite investment strategies in Europe right now. We're really focused in on it and expanding our existing portfolio because of exactly that. It is overlooked. So yeah.
Well, very good. I think that some of the insights we've had so far, I think it confirms a compelling argument that self-storage is continuing to be a great investment option for people and investors out there to look into. And also with the addition of Simon's point of maybe slow down a little bit, do it right, get all the steps in place, get the right team in place, get your network in place, and make sure that you're starting off in this sector in the right way. We can't sort of drive that point home enough, but I think from everything we've heard, it is still a very, very, very strong, resilient investment choice for people out there. So that's really, really positive to hear, definitely from your perspective, Caleb, for sure. To conclude a little bit, I would like to switch more from the front end of the journey towards the back end of the journey. We often hear from our own client base and what we see in the news and in the market that M&A within the industry is quite high. There are now, brands that are looking to exit, and whether it's going off to companies like a Heitman, whether it's being sold directly to somebody else. But people are now coming into the sector not just evaluating it as a lifestyle, passive income generating business. This is now a business that we can invest in, scale, and get an exit from at the end. But I think the misconception, definitely from what I see and my client base, is there's only really one way to exit, and that's to find a buyer, sell up, lock, stock and barrel, and go to the Bahamas. But Caleb, as you all know, there's various different ways of which you can exit a business. So just to help our client base and further enhance their knowledge, what other exits can potentially people look at, and how does that work?
The great thing about real estate is there are always different ways of coming out of things. I guess the simple one is, as you're saying, is you put a package together and you run an auction process. There's some very well-established brokers in the sector that will help you prepare the materials. You have to have your accounts in the right format. You have to have all your fire safety documentation lined up, and so it goes on. But they'll help you get ready for that. They'll run a coordinated process, invite people in to submit offers, and then at the end of the day you can pick your preferred buyer and move forward and sell. So that is a very well-established route to sell your business. There are other options. If you get to sufficient scale, you can consider a listing. That's obviously not always easy to do unless you really have that critical mass. So that won't suit all investors. You can bring in partial co-investors. Some people like to do that, or you can contribute. I've seen people contribute their assets into a broader business and receive shares in return. So that's another potential exit route. There is a trend that will probably come, you've seen it in other sectors, where you can perhaps retain the operating business but sell off the assets so that you can retain some economic exposure but release some capital, so you can do sale leasebacks. It comes with its complications, but you can do that. Or eventually maybe you'll move more into the management contract model that we were speaking about earlier, where you take some income out of it but the rest of it goes to the owner of the real estate. Over time there'll be more options, but already you have different routes of exiting, partially exiting, receiving shares in something broader if you'd like to.
Okay.
But I would say the mainstay though remains, for better or for worse, selling it in one go, and that's the typical route.
Okay. No, so some really important insights at the exit stage of some of these businesses in their life cycle. And I think, drawing back again to something we see our side a lot with businesses either entering with that goal to exit or mature businesses that are already at that exitable stage, there is a bit of I'd say misconception, but there's a little bit of a question mark over what does that look like at the end from a multiple perspective. We've heard figures thrown around within the industry that are massively high, some even really quite low and also raise eyebrows, but definitely more on the north side of those multiple figures. And I mean, with your expertise and your knowledge, can you talk to us a little bit more about what goes into valuing an exit? And what does the multiple actually mean? What do you draw the multiple from within a business? Because I think that'd be really valuable for our viewer base.
No, we're very, very happy to. It's obviously a subject. What is the right multiple is a subject we spend an awful lot of time thinking about, and we have a very intense methodology to try and come to conclusions. That first thing you look at is what have other things traded for in the market and try and draw lessons from that. And we maintain our own database, as you'd imagine, of different transactions we've looked at and how they were priced. And even when you've made offers on the transactions yourself and gone into an awful lot of detail, you can still come up with lots of different multiples. I think that's the key thing to know. When you hear a multiple, there are many different ways of looking at multiples. So if it's a business being sold, is it the actual EBITDA that was produced last year after all the head office costs? Has there been an adjustment made to the head office costs to standardise them? Has there been an assumption as to where the business will stabilise 2 months occupancy reaches 85% or something like that? Has the potential to expand the assets been incorporated? There are so many different ways of looking at the income that you can come to all sorts of different multiples if you'd like to. And so unfortunately, the only way to really, really understand it is if you've been in it yourself. Or if you want to apply it to your own business, you bring in one of the brokers who knows the sectors very well, and they'll help advise you as to how to look at the multiple for your business. So I think first of all, that's the most important thing to know, is that when you're looking at transaction comparables, you hear a number in the market, it can mean so many different things. I think things that influence the multiple we will pay ultimately are obviously how mature is the business. If it's just been opened and is making a very small profit because it's only just gone beyond break even, the multiple is much higher because over time the income will grow and you'll pay for that future growth up front. Not the same amount as if it was there already, but you will pay to recognise the future growth. We also look at the country. The multiple you put on a German investment is very different perhaps to a UK to a Swedish one, and we have a system for trying to equalise between them. We look at the asset quality, so which generation it is. Even though older assets can be in better locations and trade very well, we still factor in the asset quality, and we have a system for essentially reducing the multiple depending on the quality of the building that we're buying. Similarly, the location. If it's right in the middle of a mainstream capital city, we will pay a higher multiple, not partly because perhaps performance will be better over the long term, you might expect, but also the way you can borrow debt and create equity returns out of it improves when it's in a location that appeals to a broad capital base. So we look at all sorts of things like that in coming up with a multiple. And there's a much deeper, longer process, as you can imagine, but we look at all sorts of things like that in trying to derive a multiple. So it's one of the really enjoyable bits of the sector is it's not just when you're buying offices, and if it's a 15-year lease to a credit tenant, you can take one office building in the City of London, another office building, then there are differences depending on the credit, the tenant, differences depending on the quality of the building, location, but you can get to a very tight range on where the multiple will be. But in operational business like this, there are many factors that can go into it. So yeah, lots of people get very excited. We get excited about the multiples as well at times, but you do have to be careful. The only other factor I'd say is that sort of for an individual building, how we look at the multiple. I think the other question is if you've built a nice collection of assets and you're selling something of scale, then the multiple can change again. So once you get above, say, 100 million in value, some of those core long-term lower cost of capital investors can start to consider it because it has enough scale to sit in their portfolio and help generate the income streams that they want over the long term in a way that has a meaningful impact, because of its scale has a meaningful impact on the portfolio. Then you start to find that there's a sort of another increase in the multiple that's applied to recognise the work that's being done in creating that portfolio. So that's the other factor I would say. Beyond the individual asset side of it, there's also, if you're selling a package or a collection, what does that collection look like? So,
okay, it's really interesting to hear, because I think, and again for our viewer base, I think there's probably going to be some revelations with everything you just said there, and there's no real hard and fast, standardised method in order to value your own business and for someone else to value it. So I think really, really valuable for our viewer base to see that today, hear about that today, and learn that side of things. I mean, if you were to categorise, say, the top 5 things that Heitman would look at, what's the most important things that need to be in place or at a level that makes it viable for the likes of an institutional investor to come and have a look?
Yeah. So we invest in two main different ways. One is with this long-term lower return requirements, so lower cost of capital, so money that can pay a higher multiple because it has a very long-term view of the world. And we invest with money that has a shorter-term view of the world, that's trying to create a lot of value relatively quickly and then ultimately sell to that longer-term money. And I think when we look at that short-term money, we can do all sorts of wonderful things, small things, lots of developments. We've sometimes made 5-6 million investments to start with a view to then scaling rapidly to something much bigger. So that money is very flexible and can do all sorts of wonderful things. The longer term money is looking for a certain size scale to it, so it's normally that 100 million plus figure. Certain amount of quality, so assets that are newly converted or newly built within the portfolio of a sufficient proportion. The size of the assets, so if you're running manned stores, obviously there's a trend to unmanned, but if you're running manned stores, assets that are small are much more volatile because obviously there's more of a fixed cost, and so the income streams become very volatile, so that tends to put us off. If there's leasehold assets in there, that puts us off. If there are things like containers, we own containers, they work perfectly well, but as an institutional product, they are seen differently, and so there's a high proportion of containers that can put us off. The locations of the assets, rightly or wrongly, when you're an institutional investor, you want to see certain big cities as part of a portfolio, if it's UK or Swedish or whatever it may be. You don't want to see just lots of small cities. You want to see towns that when you go to your investment committee, there may be a global investment committee, they recognise the locations and feel comfortable with them. So you look at the mix of locations within there. You're looking at the operations. It's in these lower, longer term investment strategies, you want to know that the operations are sustainable. So what does that setup look like? Are you buying a whole business with a good management team that's going to stay on and are committed to long term, and if one person leaves, it has enough depth and breadth that the business will keep running? Or is it something small, the founder's leaving and there's not much of a team behind it, and you're going to have a journey kind of re-establishing it? That comes into it as well. And you've got that quick make a turn bucket, and then you've got that long-term bucket. The long-term bucket, once you get to sort of 70-ish% occupied, there's still more to go, but that's actually sometimes a good thing, because the buyer coming in can say, all right, there's an income stream I'm getting straight away, but there's a bit of growth in it that I'll get over time. And sometimes they use leverage, sometimes not, but if they want to use leverage, there's already an income stream that you can borrow against, so they can get the leverage they want. They have the income, so from a sort of asset liability matching point of view, they're getting the income they want, but there's a little bit of return in it from the upside that will come through. And so you don't need to get it to 85% occupied or whatever your target is. You can sell it with a little bit of room in it, and buyers quite often like to see that future potential.
Gives them some meat on the bone to still go out.
Yeah, that's
absolutely.
Right. But with our fast money, we're always thinking about that. With the money that comes in, tries to create some value. We're like, okay, when we want to sell, what does it need to look like? Don't do lots of developments in the last few years before you want to sell, because then you'll just not have the occupancy. Yeah. Don't buy. If you speak to the operating teams, and when we do our own analysis, some of the best markets are not necessarily the capital cities or main towns. They can be outside of those. But when you want to sell to an institution and they have to write their memo to recommend a purchase, if it's just in these small towns that they've never heard of, it may work operationally, but it doesn't feel comfortable from a capital markets point of view. Just even though you have everyone with the same life needs, doesn't matter if you're a big town or a small town, you have the same life events driving it. You can't. When you go into investment committee, you just don't feel comfortable, because if you had an office building in some of those towns, it would not probably be a great success story over the long term. So,
but we that's an education piece, though, isn't it? That's to say this is atypical. This is not like that asset class. This is separate and in of itself.
Yeah.
So look at it from the perspective of who lives around there. Are the local towns encroaching on that? I mean, I know a couple of sites that are built on farmland, and since they've been set up, towns either side have essentially merged around them. So they've suddenly got a huge new population of people that they didn't think they would ever get, and they're opening new parts of their business all the time.
For somebody who's running long term, so the sort of lower cost of capital, which is what jumps it up, is the long term capital. It's not the fast money trying to come in and make a quick turn. It's the long term. This is going to help. I've got liabilities that I need to offset, so pension payments, whatever it is, and this is a good match against that, and this will keep over the next 15 years. This will help balance it out.
That's a really good point to get across. I think that you're not in it for a quick turnaround. This is a longer term investment, and again, that might put some investors off. But on the other side of that, if you are looking at that long term, this is one of the safer asset classes to be looking at.
That's right. And so for that sort of money, and we run money that's more like that. We run money that's also quick turnaround, make high returns in a short space of time. But for that long term money that can pay the higher prices, it's normally got a broader portfolio, and it's trying to think about the way that money works. It pools together, and for efficiency purposes and diversification purposes, it pools together. And so it needs something that's big enough for that bigger pool of money that you can bring in the self-storage, and it starts to have an impact on the portfolio. If it's a 20 million asset value and it goes into something like that, unfortunately, it doesn't move the needle at all, but you then have to manage it, understand it, to make sure it keeps generating the income you want out of it. So at 20 million, for most of those sorts of pools of capital, it just doesn't work. 100 million, there are pools of capital where you're like, okay, this is worth going after. Lots of factors like that go into the consideration for that sort of institutional exit.
I think, again, a really valuable thing that we mentioned was, there is a misconception, including myself, that if you do own a site, that you want that to be high yielding, fully expanded, no more room for growth, 95% occupied, really, really mature business. But that might
brand new reception area, everything looking absolutely spick and span.
Yeah, it might be, and on paper, that's sometimes what a lot of people would look for, is that now I'm a really viable exit because everything's brilliant, everything's where it needs to be. But I think drawing back to the investor mindset but I want something to go at. I need something to expand with. I need. If you've got an extension that you've got planning for that can go on the side of your building, maybe not put it on yet. Give the investors some meat on the bone in order so they can in some part guarantee that return from that investment. So again, I think the misconceptions around exits and values and how the likes of Heitman would work and how they're categorised, what they might look like, is, again, it's a really unknown area of the market, and considering the level of M&A that's going on within the industries, it's become apparent it needs to be educated. People need to know about this, and again, it's the value that a platform like this is going to bring to the market in tandem with the SSA and obviously the likes of Heitman. So some really, really strong points there. Anything you'd like to pick up from it?
I think the key takeaways for me, there's probably two. One is about start to plan your exit from day one. We were talking about being prepared and the gold rush analogy of having everything right, getting the right tools and equipment and training before you start out on that journey. So start to think about your exit as an operator. Go back and look at your team. And again, on succession planning, make sure you're dispensable. Make sure your team will be ready to take that business forward, because that's what an investor's looking for. They're looking for that longevity in the business. And if you exit and everything's in your head, that's going to fall apart, and that will not be attractive to them. So I think that's a really, really important point. So think about that from day one. Make sure you've got that structured right through that process.
Yeah, completely concur.
Well, as co-host, thank you for letting me finish things off.
Simon, the outro is supposed to be my bit.
Well, give me a shot, okay? Let's see if I get it right.
Okay.
So we've summarised where we've got to. I think it's been absolutely fantastic to get that insight into the where you need to be as an investor, but also as an operator, where you need to get to get to that point where you're talking to investors, whether at the start or end of your journey, and how you get inside the minds of someone like Caleb. Just wanted to say thank you for brilliantly hosting or co-hosting,
No
and
problem.
thank you to Caleb for coming along and giving your insight. Really, really appreciated it.
Thank you for having me on the series.
No, it's been an absolute pleasure, and we know you're probably a very busy man. So really appreciate your time today, and I think the overall snapshot is that our viewer base is going to be able to take some real golden nuggets of information away from this session today, and that's what we're all here to do it for, is to educate, elevate the market and the awareness. So really appreciate your time, Caleb. Thank you very much.
Thank you. Great initiative. So thank you for doing it.
Right then, I think we'd all agree we've had some fantastic insights during that session. Very fortunate to have Caleb Mercer from Heitman to join us today. And I hope it acts as a catalyst for anyone watching, to explore the self-storage industry more, and come and join this revolution. I do want to touch upon a couple of key takeaways that I think that are important just to reiterate at the end of this session. I actually highlighted a bunch of key takeaways, but I think there's two really, really big ones that I'd like to leave us with. We've just had the managing director of the European arm of Heitman with us today, and in his own words, after working in multiple different markets from the investment perspective, self-storage has become his favourite sector to work in. I think you've got to hear that statement. It should give you a lot of comfort. It should give you a lot of support to make the choice to enter this sector. And I think for me, the other biggest key takeaway was hearing, investors that have already got, a lot of wealth tied up in multiple different markets. We're now starting to see this shift where they're now reallocating that investment and those funds into the self-storage model. Because it is so much more resilient than other markets, definitely during this turbulent time that we find ourselves in, globally, locally and economically, it should give everyone out there, a real level of comfort. It's a real key indicator that the industry is in a really strong position, and it's continued to grow into that strong position. If we have, wealth managers around the globe that are now reallocating assets and funds to within our sector because of its resilience. Right then, some fantastic insights. I'm sure you'll all agree. Really valuable information and knowledge we got there. And we really hope it acts as a catalyst and gives you a level of comfort and confidence that if you are looking at the self-storage sector, or even if you're not at the moment, it's still a very resilient, very buoyant, very, very, very strong industry to be in. But look, join us next time. We're going to have an exclusive and we're going to be delving into the 2026 market analysis and predictions. I will be joined by my now co-host, Simon Forrester, from the SSA. We're also going to be joined from a representative from Cushman & Wakefield, the authors of the SSA Industry Annual Report. So for now, That's all, folks. As they say, we're going to sign off, and in Cuboid tradition, we're probably going to head to the bar, but we'll catch you next time for the next episode of Locked In.